Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, October. Oh, let me get my mic a little closer. My bad. Welcome to this Tuesday, October 1st, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for another trading day. Pretty good action on the market yesterday. We did see most of our indices climb. Again, yesterday we saw the VIX drop back down below 17, so on the surface looked pretty good. Looking underneath the surface, not so great. If you look at the leadership yesterday, even though we were moving back higher, trying to set new highs and so forth, we did see leadership. We'll go over it in a minute, but we saw some leadership from more defensive, value-oriented companies, and unfortunately, that's really not what we want to see on a big breakout. It always, it doesn't have to be technology, but we do want to see, at least a couple, 2, 3 of those aggressive groups, meaning could be technology, could be communication services, could be discretionary stocks, financials, industrials. Those are the 5 I really look for leadership in the market. And so when I see the market go up, threatening highs or making new highs, and getting leadership from areas outside of those aggressive 5 sectors, that just makes me a little bit cautious about the rally. And of course, we've been talking about caution. I mean, we got to get through October. It's nice to get through September. I mean, really, July through the end of September is historically the worst time of the year. But we do have some history with October, with the market taking some pretty big drops. And so I'm feeling a lot better about the market. The fact that we did get through the summer months pretty much unscathed. We had the big drop back at the beginning of August. But other than that, we've seemed to have overcome some of our fears. That VIX, which was up into the 20s and well above, we did see that pull back now. We're back down, like I said, below 17. So some of that is good. I do think we're going to have a strong fourth quarter. I still think with the presidential election coming up, we do tend to see some weakness in October during those years. And so I'm still just bullish, but cautiously bullish here in the near term. Like I said, I think we'll finish the year pretty strong. I mean, anytime you've got a falling interest rate environment, and that interest or that falling or those falling rates are due to a reduction of inflationary pressures, that's different than cutting rates because you're seeing economic weakness. So we've got a big jobs report coming out this Friday. Of course, the ADP report comes out Wednesday. Then we'll get the jobs report on Friday. We're expecting, I don't remember the exact number, but I believe the non-farm payroll is somewhere around 140,000, similar to what was expected, what we saw last month. If that number is higher than expected, I would expect the market to really like that, because they do now know that the Fed has kind of felt like inflation's conquered. Some of you may disagree with that. That's everyone's choice. The numbers I've been seeing for a long time, I've been saying I think that inflation's been under control for a while. I thought they should have been cutting rates earlier, but so far, the economy has continued to be pretty strong. So, it's hard to really argue with it when, market continues to do well and the economic reports come in fairly strong. It does look like there's still a very real possibility of a soft landing, which the stock market would like with rates falling. Anyhow, let's take a look at what happened in the market yesterday, and we'll go from there. We did see the Dow Jones Industrial Average yesterday gaining a whopping 17 points. Trying to get this. There we go. Gained 17 points, which was just a little bit above the flat line. And you can see the uptrend in the Dow Jones remains intact after breaking above what looked like a double, triple top. So it's good price action, no doubt. Again, look below the surface of that signal, and it's kind of iffy, especially yesterday. But again, we'll look at all the leaders and everything here in just a second. S&P 500 also up yesterday. It was up 24 points, a little bit more of a move back to the upside. 57.62 is where we stand right now. NASDAQ 100 gaining 0.25%. That was 52 points. We are trading up above the rising 20-day moving average, which is closed above the 50. So we do have the more bullish configuration now taking place on the NASDAQ 100, and this has been a lagging area of the market. Normally, when we see the technology leaders going, that's when we'll see the NASDAQ breaking out. Right now, we're not seeing that yesterday, although we did get a nice pop from Apple and that computer hardware space, which I'll talk about in just a second. Mid caps up slightly, fractionally, up almost 0.1%. And you can see we're got kind of up against some key resistance around 31.50, closing yesterday 31.2194. So really wouldn't take much to forge a breakout on mid caps. Small caps up 0.25%. That was about a half a point on the IWM, finishing at 220.89. We've got clear overhead resistance that we're watching there, up at about the 225 level first, and then the all-time high around the 235 level. So those are going to be the two key levels to watch, especially if we get that good jobs report this week. I wouldn't be surprised maybe to see the Russell 2000 finally make a significant breakout. Transports also been moving, trying to get above this 16.3, 16.4 level. We've been trying to get through that for a long, long time now. Transport's one of the ultimate laggards throughout the bull market run. We just haven't been able to get any kind of sustainable breakout to the upside, but we are on the verge. We're very close to it. If there's one negative on this chart, it's this AD line. Same thing you can see with the IWM, by the way. Not getting a whole lot of, when I look at a weak AD line, I just think, okay, it's not very good afternoon action. And normally in a bull market, what you see, if there's going to be weakness, it tends to be in the morning, and then you get strength in the afternoon. So AD line being weak maybe just gives me pause. Remember, AD line, PPO, trend lines, sentiment, all these different things, these are secondary indicators. So if we can get the breakout on the transports, I mean, we can point to everything that doesn't look great, but the bottom line is you're breaking out above a key resistance level. So I wouldn't take that lightly if we do get a breakout on the transports. But until we get that breakout, this bothers me. So when I'm not getting that follow through, I'm not getting that additional comfort from a stronger or strengthening AD line. It just makes me wonder if we're going to get that breakout. If we do get it, that's great. But let's keep watching this group closely because we are moving into the time of the year, fourth quarter, when the transports tend to do their best, November in particular. So we're getting close to the time frame where we do see the transports make a move. And so for that reason alone, we should be watching it pretty closely. All right, moving on to the sectors, real estate gaining almost 1%, actually a little less than 0.9%. But still, look at this beautiful move we've seen over the last 4 months. I mean, we continue to trade above the 20-day, which is above the 50-day. Yesterday, we did see a bounce. And again, this is part of what bothered me about yesterday moving up is that you can see real estate up almost 0.9%. And we move over to energy, which was up 0.7%. Healthcare, which was up 6.5%. And these are all groups outside of the 5 aggressive sectors that I talked about earlier. So it's just that, it's just easier when the market's moving up and we've got the leadership we like. That is indicative of a very strong secular bull market advance, one that gives me very few reasons not to want to be involved in it. I absolutely would want to be involved in it. This one I think we're going to get that big breakout. I think it's going to be more meaningful at some point, maybe a little bit further down the road. But so far, the market's been trying to prove me wrong. And, it really hasn't looked to pull back at all. It just continues to move higher slowly, but continues to move higher. We'll see if that continues. Here's the computer hardware group gaining more than 2% yesterday. So even though technology overall did not do well, computer hardware did lead. This was the best performing index across, all over 100 industries. Computer hardware was number one. So you can't overlook that. It did take out a double top here around 11,500. And Apple was the primary contributor. Apple was up, I think, $3 or $4. So really good move on the computer hardware group. Then we had delivery, air delivery, air freight moving up above the but back up above both moving averages, trying to get through this double top, which is up around the 1340 level. If we could do that, that certainly would add some more bullishness. But this one, I'd be a little cautious with just because it's been going sideways for a long time. and it is just now getting up to some key resistance. I'd like to see that breakout before I got a little bit more bullish on the group. But one group that has been very strong, this is in the discretionary area, home improvement. Home improvement jumped another 1.32% yesterday, and it's been on a heater. All of the month of September, been moving up, gotten back through the 20-day. You can see the 20-day really starting to pull away from the 50-day. That tells you, and the PPO very, very strong, rising. It's the highest level we've seen in the last 6 months. This tells us this is a group that's got a lot of momentum to the upside. So any pullbacks in some of the stocks within this space, I mean, look at Home Depot, Lowe's, those types of companies. They get pullbacks. Generally, when you see this kind of configuration on the chart, it would be buyable. So those are some areas to look at for sure. All right, let's go on to the 10-year Treasury yield, get a quick update. And also, let me just take a look quickly. I did not see. Well, we've got the PMI manufacturing index, but that doesn't come out for another half hour or so. So really nothing this morning of any significance out in terms of economic reports. And so kind of left the trade on our own without a whole lot of economic reports or earnings reports. We are now into October, though, so we're within a couple weeks, less than 2 weeks, actually a week from this Friday, from getting those big banks out. So we'll get JP Morgan, Citigroup, and so forth reporting at the end of next week. And so that'll give us a first glimpse of what we might expect as we move into this earnings season, what kinds of reports we're going to get. I don't know what the actual reports are going to be, but I do think many of these financials are going to raise guidance with the environment of the short-term rates coming down and the longer-term rates, like the 10-year Treasury yield. It's been coming down, but it recently, as the rates were cut and we saw the big drop in the short-term rates, really we haven't seen that. We've actually seen the opposite in the 10-year going the other way. So we're getting closer and closer to inverting that yield curve, depending on which yield curve you look at, whether it's 10-year versus the 2-year, 10-year versus the 3-month, 10-year versus the 1 month. Everybody looks at it a little bit differently. I think the standard is probably the 10-year over the 2-year. But anyway, we're seeing that start or trying to uninvert. And I don't think that's going to necessarily be a bad thing for stocks this time. 2000, 2007, it was. We saw big, of course, that was the start of a secular bear market, and we saw some big drops in our major indices. I think the thing that's different is the reason why they're cutting. It's not because of a slowing economy. It's not because of a recession that they believe is coming. They're cutting because they believe they won the war on inflation. And I think that's a different animal. And if you look back into the 1980s, look back a little bit further, even into the early 90s, you'll see that when inflation started to come down and rates started coming down as a result of inflation coming down, we didn't get the same reaction that we got in 2000 and 2007. So those with short-term memory, and only look the last couple times we've had a bout with inflation and saw the rates coming down, they also coincided with weak economies, especially 2000. That was the end of a multi-decade secular bull market. It was just completely different animal than where we're at right now, in my opinion. We'll see how it plays out. But anyway, the 10-year Treasury yield today is down about 6 basis points. So we closed over 380 last week. We're down to about 374, just a little under 374 today. So it looks like this is another push to the downside, which I think would be, bullish to see the 10-year Treasury yield continue to drop. This is tied to mortgage rates. So anytime you see the 10-year Treasury yield doing this, what it's been doing over the last 5 months, that tends to be very good for the mortgage market, for lending, for folks buying homes, and so forth. So we'll see how all that plays out. But right now, 10-year Treasury yield, in my opinion, is heading in the direction to help the secular bull market, not hurt it. All right. S&P 500, try to go through these pretty quick as well. S&P 500, you can see, had that big dip late July, early year. I was very cautious back then, I'm not going to lie. But we did come right back up, threatened the prior high, one more pullback, and now we're in breakout mode and territory. Yesterday's action, by the way, was really the best day in terms of intraday price action. We've seen gap ups. We saw a big one on Thursday after the Fed meeting, week ago, but we didn't. We had. I mean, we're trekking a little bit higher, but it doesn't feel like a whole lot of intraday buying. It's been some gap ups and sideways movement. Some selling followed by some buying. The one thing I will say is that these candlesticks have been very boring, not really big moves in one direction or the other. And that's kind of a hallmark of a secular bull market advance. So we've got some mixed signals for sure, but we cannot ignore the fact that we've moved all-time highs. And so for me, again, I've been talking about being very, very bullish long-term. That stance has never changed. I've been like that since 2013, since we had the breakout into a secular bull market. I believe that was achieved in 2013. And I've recognized some weak periods. I talked about the cyclical bear market in 2022 before it occurred, but that doesn't change my long-term view. So short term, I just think we're a little cautious, little, sideways action. Wouldn't be surprised to see a little pullback, maybe hit the 20-day, possibly a little bit more since it's the month of October. But long term, we go out beyond that. I'm bullish, very bullish, and have been. So I just think the interest rate environment remains low. It's coming down. We've got an economy that's been very resilient. Started to show what I thought was a little bit of weakness in July, but even that's turned back around. Initial jobless claims have gone back down. Unemployment rate, we'll see what happens again on Friday. But last month, unemployment rate ticked back down. So there have been some good signs with the economy. And if the economy remains strong, doesn't have to be great, but even if it's just positive and we're able to bring rates back down, the stock market's going to look ahead and is going to view that as a positive for the economy. So I see the market going higher. But again, short term, got to have a little bit of caution here, I think, again, just because of historical periods that we've seen in the past. And some of the leadership, by the way. Technology is still struggling. That's not, technology hasn't broken out. So it's not all about, history. We got the presidential election cycle. There's still, overbought conditions. There's still some other things we have to at least be aware of. NASDAQ 100, this is the one that is definitely strengthened. Hasn't gotten back up to the highs and set new highs like the S&P and the Dow, but it is strengthening. It is trading above the 20-day, which is now trading above the 50. The 50-day was going down. Now it looks like it's starting to turn back to the upside. So I think the key for the NASDAQ is when we pull back, you've got this breakout above, 19.9 or so that we made. So pulling back and hitting that level would give us short-term support. Further short-term support would be that rising 20-day moving average, which right now comes in at 19,636. And that's only, 400 points below where we are right now. 2%. 2% really isn't a whole lot. Down to the 20-day, I think it's fine. If it breaks below the 20-day, then I think we potentially could have a little bit more downside action before what I think is going to be a big fourth quarter rally kicks in. Small caps, IWM, there's what I'm talking about, this 225 level I mentioned earlier. You can see it coming across here. We've had multiple attempts, had a false breakout there. Now we're trying to hold the rising 20-day, which is, again, above the 50-day, which 50-day is flattening out after moving higher. So overall, this doesn't look like a bad setup for the IWM, but we need that breakout. We need to get back through that 225 level to get this group not just moving higher, but leading. We'll see, again, whether or not that happens. But I think as we start seeing more of the financials report, more of the industrials, I think you're going to see not only what could be some pretty good reports, but I do think their guidance is going to be strong. Transports, bumping up again, 16.3, 16.4, like we've been doing most of the year. 16.2 up to about 16.3. And even here in September, kind of pushing on that ceiling, trying to break through. We did go up to 16.4, just a little bit above it a couple of weeks ago. That was right after the Fed meeting. Let's see, what else do we have on this chart? Well, I mentioned the AD line. That doesn't look good. So I want to see the breakout, and I really want to see this AD line start to turn back to the upside. I did look long term, and we have been struggling on this AD line for probably the last year and a half. But I think if we get the breakout, I think that could change. I mean, we've gone through periods where the AD line's gone down. We've even made breakouts. but you can see when you make a breakout and the AD line doesn't follow, we ended up coming back down for quite a while. Then we started moving up with the AD line with the transport group into 2023. So let me try to zero in here. So there was the big move here. And if you notice, there was the AD line setting new highs going along with it. But right now, as we go sideways and as we attempt the breakout, you can see the AD line continues to move lower. So I really would like to hold this support area and see that AD line turn higher to accompany a breakout. And a breakout at 16.4, by the way, isn't a complete breakout. We still got highs from the last few years, several years, that we have to negotiate. But this would be the first one, in my opinion, getting through 16.4 and sustaining it to the upside. All right. For those of you who are new to Earnings Beats that maybe are following us for the first time or just recently started following us, if you go over to our website at earningsbeats.com, so both are plural, Earnings Beats, you'll be able to scroll down here and see we just had an event last week where we were talking about the history of market bottoms and especially fourth quarter bottoms. And that was kind of a lead into a much, much bigger market vision event that we're going to be doing this weekend, this Saturday at 10 a.m. These types of events, these market vision related events, have always been open, well, primarily in the past, been open to annual members of Earnings Beats. What we're doing this weekend is anybody who is a trial member can come in. You can click on this to get more information and to register. You will need to be a trial member, which means you do have to provide us your credit card. However, we do get in touch with everyone. We send out emails before your credit card is charged to give you the opportunity. You got 30 days to cancel, and we'll give you, a last minute chance as well at the end of toward the end of your 30-day trial. But check out this event, the Market Vision event. What I'm basically do at the beginning of the year is I do a complete analysis of the market. I go into sentiment. I go into relative strength. I look at all the various sectors, see what's been leading the market, talk about history. I mean, it's all in there. Divergences, anything that, the Fed, inflation, it's going to be talked about. Gold, if you're interested in gold, the dollar, pretty all-encompassing analysis of where the market is as we head into the fourth quarter. So if you want to be there on Saturday, I can tell you it's going to be an eye-opening event. I'll give you my thoughts about the fourth quarter and even into 2025, what I see. But make sure you go over to our website and register. If you haven't already signed up, we do have a free newsletter, no credit card required. You can unsubscribe at any time. All it takes is a name, email address, and you can hit that subscribe button and get your free newsletter subscription started. That's a newsletter that talks about things that are important to us at Earnings Beats. So it's twice a week. Normally, it's just an individual chart where I'm pointing out maybe relative strength, maybe a breakout, maybe a 20-day test. Could be anything technically. I could show a sentiment chart from time to time. Could talk about, relative strength. Could talk about the Fed, something to do with the Fed. Maybe jobs report. If the jobs report's strong or weak, maybe it's a stock that I think could do well. Anyway, I think it's something you can just add to your repertoire. And if you find some things that are of interest, I think can help in your trading. So anyway, those two things, if you go over to our website, I would definitely check out. But I'd really like to see you Saturday morning. I think you'll enjoy the event. And again, it's going to be an all-encompassing, probably a solid hour and a half of talking about the market, where we stand, and where we're likely to be headed in the fourth quarter. And anybody registering also will get the chart list that I use. Well, actually, that might be reserved for our annual members, but we'll talk about that at the event. Should be a great event. Hopefully see you on Saturday. All right, chart of the day. So we don't have a chart of the day on Tuesdays. We do them Mondays and Wednesdays, but I'm going to give you an extra one. This is what we usually do on Tuesdays. Anyhow, GM. So if we are on the verge of maybe having a stronger fourth quarter, you can see GM has a triple top in play up around $50. We have been pulling back here over the last 7 days or so, and we're now back down to a key support level around 44. The bigger support level is just below 40. If you're someone who likes to swing trade, hold on to positions for a while. Entering at the current level, in my opinion, isn't a bad area. I'm not a registered investment advisor. I'm not giving advice. I'm just pointing out from an educational perspective, we are approaching a key support level here. So an entry at this point, if you so desire, would be okay. A second entry down closer to 40, if you're somebody that wants to hold longer term, maybe give GM a little bit more room, then I think holding off and potentially getting a second entry down near 40, if the market were to turn lower, or maybe just autos turn lower, that would average you in about $42 a share, which I think on this chart would be pretty nice entry point, or average entry point. But first, I'd be watching this support around 44. We may hold here and simply move back up and break out. But I do think GM is at an interesting level, and I wanted to point that out. All right, we got about 4 minutes left. Let me give you the futures this morning. I didn't do that at the top of the show. So let me tell you where we're at as we move closer and closer to the opening bell. We've got the Dow Jones Industrial Average, the diamonds that track the Dow Jones. This is an ETF. It's down about $1, which is a little bit more than 0.2% this morning. The Spider S&P 500 down 0.1%. That's down 50 cents. No real big shakes there. The QQQ tracking the NASDAQ 100 down about 0.1%, down 0.5 point. And then the IWM tracking the small caps down about 0.25%. So that's down 56 cents at 220.32. So that's where we stand right now as we get ready to open here in 3 minutes. I did want to show you, though, how you can get to using some of stock charts predefined scans. I try to show this once in a while, but if you're on your dashboard, you should come down and see your scans. If you don't see that, then over here on the gear, this little gear shift thing, you want to make sure scans and alerts are checked. So if you don't see it, chances are it's not checked. Check it, save your preferences, and then when you come out, you should look down and find the scan, your scans. Now, under your scans, you can go in and do your own, or under this little more drop-down menu, you can come down and see predefined scans. So Stock Charts has already done a bunch of scans for you. You don't have to do anything. A couple of things that are important about this. If you pick one of the scans, like say the 52-week highs, and I'm doing it just on the NASDAQ, I click on that. Here you can see this button, Edit Scan Criteria. So if you're not familiar with how to write scans, one of the best ways is to see how Stock Charts writes the scan to give you the new 52-week highs. Pretty simple. There it is. And if you want, you can save it. Just take that, hit save, rename it, and it'll give you the new highs. And you can get rid of some of this if you want. Like for me, I would get rid of this OT. I don't want any of these over-the-counter bulletin board stocks. So just get rid of it. If you want stocks that over the last 20 days, the average daily volume is 40,000, you might want 50 days and over 200,000. And then the daily high is greater than yesterday's daily max, going back 253 days, which is roughly the equivalent of a year in terms of trading days. But if you just wanted 1 month trade, let's give me stocks that are moving to a 1 month high. Trade that to 21. That's roughly the number of trading days in a month. Anyway, you can take it and adjust it. So you can learn to do scans based on what Stock Charts already provides you. Now, the actual scan of the NASDAQ stocks itself, one of the things I would consider doing is sorting it in scooter order. So this is the Stock Charts technical rank. It just gives you a better idea of which stocks are showing relative strength. The higher the scooter score, the better the group has been. Now, you'll see some things like these leveraged ETFs or whatever. I mean, I ignore that. I would be looking more at some individual stocks. I might sort this by industry group or sector. I really like financials and industrials, always do in the fourth quarter. They tend to do their best in the fourth quarter. And today we're starting the fourth quarter. So maybe take a look at this and sort it by sector and then go down and look for the financials. We already had it in scooter order. So if you do it in scooter order first and then click on sector, it will bring up financials in scooter order. So now these are stocks that were setting new 52-week highs in this, and probably some of these lower scooter scores, they might just be making a breakout. I would think any of the high scooter scores probably have been really strong for a while and are probably overbought. But maybe you start getting down the low 80s or in the 70s. Some of these, TradeWeb, let's take a look at it. It's scooter is at 80. It's in investment services. I mean, it's not exactly going straight up, but it's broken out. Pull back to the 20-day, though, would look pretty good. Very strong stock. Look at that AD line. So this is just, a quick tutorial on how you can use the Stock Charts website to quickly come upon some stocks that might fit into what we talk about at Earnings Beats. We talk about certain areas of the market that like certain times of the year. Use that information. You don't have to be a scan genius. You just go in and use the predefined scans and then look at that criteria, and you can start to learn how you write scans over at Stock Charts. It's a powerful website. Make sure you use it as best you can. Anyway, market just opened, so let's get a quick look at the market, and then we'll wrap this thing up today, almost on time. You can see we are down a little bit here at the open. We've got the VIX is back up almost to 17, but not a lot. Small caps down 1/3 of 1%. Same with the Dow. NASDAQ just down 0.15%. So that's between 1 and 2/10. Really not a whole lot. You can see SMI taking another big hit today. Just looking at the S&P 500 down. Oh, no, that's not down. That's a split. Forget about that. They're going to have to adjust the data over at Stock Charts, and I'm sure they will later today. But SMCI actually split 10 for 1. So if you go to the chart, now you're seeing it at 40 instead of 400. But it is up slightly, less than 1%. But yeah, SMCI did get that 10 for 1 split. Much more affordable at this point, but it has been under a lot of pressure. Longer term, though, I don't think this is a bad area on the stock. I mean, if we go back 3 years on SMCI, you can see we went sideways for quite a while, and we broke out right at about that $35, $36 level. Went all the way up to 125, and now here we are back down near 40. I mean, this is a really good stock long term. Likely got way ahead of itself. Easy to see now after you get a big pullback. But now it's back down close to where we originally broke out to make that move. So I think the 35 to 40 area is going to be critical support for SMCI. Anyway, let's go ahead and wrap it up. I do appreciate everybody tuning in. Be sure to like our video and subscribe to our channel. That would certainly help us in the algorithms and so forth with YouTube. And we are trying to build our community, trying to teach a lot of folks about the market, things that we know, things that we've learned, try and share those with everyone in the market. So we get a lot more people benefiting from the stock market. That's really our goal. So again, be sure to like and subscribe to our video. That would be awesome. And I'll see you next time. Have a great day, everybody. Happy trading.